Hello everyone, good afternoon. Welcome to a tax flash webinar. Today we are talking about a very hot topic, the recent guide on the free zone person. With me, I have Komal, who's the manager in our corporate and international tax team. Komal.
Warm greetings, everyone.
And I'm Prateem. I'm a director with our direct and international tax practice. Like I mentioned, there's a buzz in the market regarding, what's been updated since the last legislation, what kind of clarifications have come out, because when the law had come out, there were certain gray areas, whether those have been filled in or not. And Komal will, and I will try our level best to try and, tackle some of those issues. And today, how we have structured today's presentation is that, we're going to talk about some key aspects, not discuss all the qualifying activities, and focus on certain important and critical ones in the time that we have for UAE. And if your business or if your industry has not been covered, feel free to reach out to us. With this, let's begin the presentation. So before we begin, I think it's very critical to understand what the timelines have been till now. I think a lot of people are don't know how it all started, right, Komal? So I think it's very critical to understand that. So it all begins in December 2022 or October. If you have to look at when the law was actually officially published in the Gazette. So Federal Decree Law number 47 came out, which had certain benefits for qualifying free zone persons, and it said that you could get a 0% corporate tax on your qualifying income. But what were the qualifying income? That was not very clear. What was defined? What activities would be covered? That was covered in the form of your cabinet decision 55 and ministerial decision 139, which came out around June 2023. After reading those, there were a lot of I would say certain gray areas or gaps, and not all businesses were being covered. Because of that, the government came out with a public consultation document shortly after that, seeking inputs on what would these qualifying activities mean, what do they plan to cover, what are the other small conditions that need to be satisfied. They sought those inputs. Then after that, they came out with your cabinet decision 100 and your ministerial decision 265. So what they did with this was they repealed the previous decisions. They got new decisions in, and from the public consultation documents, they at least included quite a bit of guidance from there into the final decisions. But there were still certain practical aspects and certain scenarios that I think which were left out in terms of clarification and guidance. Because there are so many businesses out there, so many business models. People have different, transactions. Not everything can be covered by a legislation, and not all permutation combinations can be covered. And everyone was anticipating this guide to come out, and it finally did. And, this month, and this is what we're going to talk about. So this is a short rundown of what has happened up till now. Now, before we get to it, for at least the audiences that are uninitiated with the topic or want to just have a recap of the provisions. So if you are a free zone entity, you don't get this benefit of 0% corporate tax just by not doing anything or just having an entity. You have to satisfy certain key conditions. Now, what are those conditions? You have to maintain adequate substance in the free zone or in the designated zone. And by substance, like everyone must be aware, it means, you have adequate employees in the free zone or designated zone. You have enough assets, you have enough expenditure. We'll touch upon this later on during our presentation. At least, what has been clarified in the guide beyond what everyone knows through the law. Then you have to derive something called a qualifying income. This is the only kind of income that will be taxed at 0%. If you earn any kind of non-qualifying income, some non-qualifying incomes are directly taxed at 9%. Some could go on to taint the 0% by, there is a threshold which we'll touch upon. As a free zone person, you have an option of either going in for the 0%, or you might as well get taxed at a normal rate of 9% and go under the normal regime. And if you elect so, then you can't get this benefit. You have to comply with transfer pricing regulation. This is very critical for businesses where if you are interacting with any of your related parties, you have to look at, whether those pricings are at arm's length and they have to meet that condition. And that is why for, any kind of qualifying free zone person, getting your transfer pricing policy and framework done right is very critical. It needs to be airtight. Transfer pricing can be disputed, but at least taxpayers are, at least recommended to have their studies done in a very detailed manner. And again, when I, spoke about de minimis, if you have non-qualifying income above a threshold of 5 million or 5% of your total revenue, whichever is lower, then, you can get ineligible for these benefits. And very critically, free zone entities are required to maintain an audited financial statements, regardless of the revenue. So revenue of 50 million, I think, Komal, 50 million is applicable to mainland entities or other entities, but free zone, regardless of revenue, get your financials audited.
Definitely.
We keep getting these questions, but there is no threshold for that. And if you don't comply with any of these conditions, what happens? You get disqualified for this benefit, and it's just not a 1-year effect. It is a 5-year effect. So it is your current year where you don't meet the conditions and the next 4 years.
Next 4 years.
Yeah. And what, when I said qualifying income, what did I mean by that? I meant, so there are 4 kinds of income streams, which we'll get to later. You can earn a qualifying income by having a transaction with another free zone person. You can also have a transaction with a non-free zone person. That means a mainland entity or an entity outside UAE, if you're performing something called a qualifying activity. And the third being that you can have some income related to qualifying intellectual property, and the fourth being you need to any other income which is not covered above, but they have to meet de minimis. Now, what are these any other income? They've not specified, but it would rather be something which is ancillary or auxiliary to your main income. Now, remember when I spoke about some income streams being taxed at flat 9%. So what are they? So regardless of what you do, these incomes, if you're QFZP, your income from your, any kind of branch or permanent establishment that you have in the UAE or outside UAE would be taxed flat at 9% without the benefit of the threshold of 375K. So this means that while your free zone entity, the qualifying income gets taxed at 0%, your branch will be taxed at 9%. And the guide has been very clear and specific on the fact that when they're asking you to figure out or compute the income of these branches or this permanent establishment, they have laid down that you should do that through transfer pricing. What do you mean by transfer pricing? You mean that, you have to look at what does this branch do? If today you have a main entity that does manufacturing and a branch does the distribution, so all the distribution profits have to remain with the branch and get taxed at 9%, while your main entity in the free zone, which is a manufacturing entity, will be taxed at 0%. So you have to be very mindful whenever there's a head office or a branch set up, between free zone and mainland. The second kind of income that will be taxed at 9% is if it's a commercial property within free zone, but a transaction is with a non-free zone person, or it's a transaction that, pertains to a non-commercial property in the free zone. The third is qualifying intellectual property. It's related to that. Any income which is not a QIP, a qualifying intellectual property, that will be taxed at 9%, or any income through a QIP, but it's above the prescribed threshold. With that, we have broadly covered as to, I think, what majority of the public would know already by now. Let's talk about what this guide says, and let's talk about some general points. First, this is a very important point. I think something that most businesses have reached out to us for was, am I in a free zone or am I not in a free zone? And what the law says is that, there would be certain decisions that would come out listing out what are the free zones in the UAE. But, the guide, hints at the fact that you must reach out to the relevant free zone authorities and write to them in order to get a confirmation as to whether you're in one of the free zones for corporate tax or not. This is a slight departure from what the law says, like I mentioned, and practically what we have seen is that the free zone authorities normally give a very generic response and don't commit to their confirmation. So we need to see practically how this pans out. Now this second point is very, very important. So if you look at the definition of free zone person in the law, it broadly covers two kinds. If you see the plain wordings, one is your a free zone company that is incorporated entity which is incorporated within the free zone, and the second is when it's a branch of a foreign entity and the branch is in a free zone. It doesn't clearly cover a situation, what if you have a mainland entity and that mainland entity has a branch in the free zone. The guide earlier had kind of hinted that this would be covered, but right now the detailed guide for the free zone has now covered this and said that even if you have a mainland entity in which is could be an LLC and that has a branch in the free zone, that branch can also get a free zone benefit. And very oddly, but what they're going to treat the mainland entity or the head office in the mainland, it would be treated as a domestic permanent establishment. What does that mean? Again, that means that any interaction between the free zone branch and the mainland entity, you would have to comply with transfer pricing. And from my experience, I can tell you that such structures, while you keep your transfer pricing quite airtight, it could be the tax authorities usually have the tendencies to question or to litigate on how you have bifurcated profits and how you have bifurcated costs as well. And it could trigger in terms of it could be a riskier proposition than say have a holding subsidiary. Having a mainland and branch apportionment is always
Complex.
It's quite litigation heavy. Moving on, this is also something I think most of our clients had reached out that what if I'm a new entity, right? And I do not have revenue. I have all the assets. I have all the people there, but I've just started my operations. But I'm not earning any qualifying income. Can I, get the benefits? Yes, you can. This guide has clarified. But as long as in the year that you've not earned any qualifying income, you don't earn non-qualifying income. So say if you're a manufacturing entity, suddenly if you have property income like from the mainland, that could make you ineligible for the benefits. Now, one more point is that obviously I spoke about free zone entities having an election to be treated as a normal taxpayer. This election could be done for the year in which you make the election or for the next year, and the election has to be done before the tax return that you file for that relevant year. Let's move on to the next topic. So yes, this is very important. I would say, Komal, you're aware that all clients reach out, what is adequate substance. I think this guide sheds some light here. And I think let's talk about this, so whenever we did any kind of, note or any kind of advisory, because the word adequate has been, used in the law. Yeah, it's very subjective. I think, Komal, you're right. It's very subjective. There's no objectivity. They don't tell you need to have 5 out of 10. You need to have 6 out of 10 in the free zone. You have to know what you have to evaluate your business model, see what is relevant. This guide has given certain illustrations which we'll touch upon. And it seems that it's given certain kinds of, it's interpreted certain things liberally, but we need to look at it, right? And one critical aspect, I think, what this guide talks about is that when you talk about employees will not be double counted. Now, what do they mean by double counting? They mean that, so if you have one marketing manager in the free zone working as a, promoting its marketing for the entity, that same employee cannot be, be counted for information technology, service or function. So you can't have the same person discharging different duties. This could potentially throw issues when you're trying to build substance, because there are certain entities where people do two jobs or have two reportings, and we need to see those cases, whether what could be built up and how you could satisfy this condition. There's also one other condition, that what if you have one person being like, say, an investment manager, but this person discharges this function for 5 entities. Here technically they're not getting double counted for different functions, but they might be double counted for multiple entities. So what happens in such a condition? So these are still gray areas here.
This double counting looks very interesting, Prateem. We have to look how it completely unfolds in practical scenario.
Yeah, I know. And I think this is something that I think where companies will have to plan and maybe, actually look at the realities of what functions people are performing. And I think the way the tax authorities have worded this in the guide, I don't think they're going to take this lightly. Not at all. So one thing that they've again, reaffirmed is that anything that's routine and not core to your business, the routine activities can happen outside the free zone or the designated zone if you're a distributor. So you can do that. Now, any activities that are performed, say, from the domestic P, like I said, in a mainland, if you have a mainland head office or mainland branch, that activity or those people and those activities will not be seen at all when considering whether your free zone operations have adequate substance or not. So that's completely separate. Those people will be seen separately. So intermingling of people also between your mainland operation and free zone operations may not be possible. You might have to keep both operations quite separate, especially people, and that can get tricky. Now, very interestingly, we all knew that you could outsource core income generating activities from the past legislation. They've gone on to clarify that this, what does adequate supervision mean? That the people who are doing the supervision must be able to do it in a routine manner and, on a consistent basis. And it has to be demonstrated through actual contractual, agreements. And they will get into the fact that who are these individuals, how many people have you allocated in terms of looking into, looking into whether they are supervising or not. So this is a critical aspect. It's just that it can't just be an on-paper thing. There actually has to be a proper contractual agreement with proper conduct to satisfy this. Moving on, for qualifying intellectual property, I think we were aware that you could outsource this to a person, within the UAE or someone outside the UAE, but subject to the fact that they're not related party. Now, some critical examples, I think, would be, say, this is a very interesting one. The first one, where if you're a holding company in the free zone, say you just have a board of directors, you don't have any employees, but these directors are taking these investment decisions. And there was a huge question mark whether you'll satisfy substance requirements or not. They have, given some relief here. They've clarified that you would, subject to the fact that these decisions that are taken by a director would be documented properly in a board meeting. And, such companies have board meeting on a regular basis. So this is a very, very important and very critical clarification that has come in. And I think there's so many holding companies in the UAE, Komal, that I think this is very critical. Moving on, headquarter, one of my favorite structures, UAE headquarter business. And, we need to see how to structure this, but, good clarification that assuming that, what they've said in the example is that you have senior personnel of the group sitting in this headquarter, and each senior personnel have, usually what headquarters do, are in charge of certain subsidiaries, certain regions, certain businesses, and these individuals go and meet the businesses as well and the subsidiaries. They could be in the mainland as well. They could be, outside the UAE as well. And the costs are shared by the entire group. But primarily the senior officials are operating out of the free zone. In such an instance also, they have said that the adequate substance would be met. And a third example, which is a bit more, I would say, fact heavy and fact specific. And I think, say you have a free zone entity that does distribution work, and they have 50 odd employees in the DZ doing SIGA. And by I mean SIGA is core income generating activity. What would be important for a distributor, like warehousing, taking care of the logistic, buying the product, selling the product. So say 50 employees are doing this. Along with that, they have 250 employees outside in the mainland taking care of delivery. Now delivery, they've mentioned that could be looked at as a support function, because for a distributor the main function is all the activities that we spoke about. Delivery is just taking about dropping or delivering the goods ultimately to a customer. It seems like an okay structure, this, because they said that if 50 employees are within the DZ doing the core income and the support function people, even if 250 number, so 50 out of 300 is only free zone. But what is critical to see is that the functions that these 50 people are discharging, are discharging. So because they're so critical and they're core, they are in the DZ, it's okay, even though 250 which are support are in the mainland. So when I mentioned core, even a situation where warehousing is taken care by a outsourced agency in the DZ, then that warehousing is also okay through outsourcing, as long as there would be one or two individuals in this company A that would oversee this outsourcing activity, would regularly visit the warehouse, see their quality control, see how they're managing the stock. But this has to be substantiated through actual conduct. So even in this scenario, you can potentially get free zone benefit. So moving on, I think now I hand over the presentation to Komal, and she will be talking about some key key transaction, and especially trying to touch upon qualifying income. And substance was important, but you also need to earn qualifying income, right? So Over to you, Komal.
Yes, Prateem. So it's been interesting, the guide till now, reading on the substance, going through the conditions. And so coming to this qualifying income, many key aspects have been clarified. Before going to the qualifying activities, when we touch upon when there's a transaction with a free zone person, the incomes derived from a transaction from a free zone person is qualifying income only when the free zone person acts as a beneficial recipient of the goods and services. So what is a beneficial recipient is already defined in the decisions. So the person should have a right to use, should enjoy the services and goods, and should not have any legal obligation to pass on the goods. So there was this criticality where how do we know that whether they have been passed on or not? So that is where the guide has suggested saying get a written statement, get a confirmation from the purchasers that they are not passing on. They are the beneficial recipient, and that's been used for their business in the free zone. But if you see, this written statement is sufficient unless you have a reason to believe that no, they are not the beneficial recipient. The goods are getting delivered to some third person. So how do you look at this, Prateem?
So I think in terms of this, I think this last portion which you said, unless they have an example, a reason to believe. I think when you're dealing with third parties, I think undertaking should suffice, like, because you get an undertaking from a third party, and you would benefit of the doubt that you would believe what's written to you, right? But when it's a related party transaction, and if you're aware of any structure where that related party is not the beneficial recipient, there just merely having an undertaking or documentation will not suffice. You have to back it up with conduct. So in my experience, whenever I've seen such a requirement in a related party transactions, usually such undertaking, sometimes they go behind the veil and see how things are being done as per actual conduct.
Agreed, Prateem. Also, one more thing which was clarified here is, for example, let's say there's a free zone entity and there's a domestic pay, let's say a warehouse, but the warehouse conducts the entire core income generating activity. Then this beneficial recipient should be the free zone and not the domestic pay. So it should be with the free zone entity and not just the domestic pay.
Yeah, that's a critical point.
Yeah. So moving further, we'll go against each of the qualifying activity, though we have not covered all the qualifying activities which are defined in this 135-page document. Few of the important things which we are going at. First one, let's take qualifying activities for, let's say, holding of shares and securities for investment purpose. This investment purpose, again, was defined in the decision as uninterrupted period of 12 months holding or intention to hold it. So what are the aspects which have been delineated in the guide? To start with, let's go with an example. Say there's a holding company. The following assets are held for 12 months. Say the first asset, say they have invested in shares of a free zone entity. We know, it is a financial instrument, qualifying financial instrument, so it's a qualifying activity. Let's go to the second one. Cryptocurrencies. This is where it has been clarified. Though free zone guide has specifically included cryptocurrencies as a financial instrument. So when you invest in cryptocurrencies and hold for 12-month period, you will get this qualifying activity. So next one, say they have shares in overseas investment. Again, it is a financial instrument. It is qualifying activity. Let's go to the next one. For example, the holding company is doing share trading. The free zone guide is specifically told active trading is not a qualifying activity. Let's in this example say it is not an active trading. They are holding it for 12-month period, but they are trading it with a natural person. So we all know transaction with a natural person is excluded activity, but the guide has specifically clarified that if you're trading with a natural person, it is presumed as not traded with a natural person, provided you trade it through a recognized stock exchange.
Okay.
So, and Prateem, the guide also specifies certain activities constitute as qualifying activities. Can we take through the audience on what are those?
Yeah, I think interestingly, when I was reading the document, I think I saw something called financial recovery of undisclosed liabilities, which is a very interesting point where they go on to say that, say, if you had acquired an entity and you had paid us, say, 10 million to acquire this entity, later on you find out post-acquisition that entity had some case going on and the liability has arisen to you and you have incurred a cost post-acquisition of 2 million. You recovered this through the original seller. So this will be an income to you, even though this is not directly from the shares you acquired, like say a dividend or capital gain, but it's kind of related to your earlier transaction or acquisition. They still said that this would be a holding activity or qualifying activity. So it's very interesting. And they've also gone a step further and said that, say, this is presumed that you didn't have an indemnity, or a lot of acquisitions are done through an indemnity clause or claim. So even when you kind of seek an option on that would also be a qualifying activity.
This eases a bit on the holding activity. It's not making it very stringent is what I
I think they've done a very good job in terms of making things broader and more liberal in terms of interpretation. I think now with the guide, I think they've kind of bridged the gap between economic realities or how business is done in the UAE vis-a-vis the law, right?
Definitely. Going ahead with the other next qualifying activity, your favorite, headquarters services. So they have given an exemplary list of activities. They have defined it, starting from management strategic decision, where you take strategic vision, where the headquarters provides these services. When they give suggestions on operating expenditures, by coordinating with the group activities, say the shared costs, which we talk about, all our clients have these kind of expenses, financial management, all human resource, right from hiring, payroll processing, and technical support, legal compliance, and importantly, administering management of patents, intellectual properties. So all these have been listed down, which gives us a clarity.
I think what happened was, I think when the law came out, right, Komal, I think, they defined headquarter services, but most groups were worried about, is UAE going to look at a headquarter in the UAE similar to how rest of the world looks at it? There's so many activities that headquarters do per se that wasn't fitting into the definitions that were provided. And how much can I do? Like, one problem is that a lot of multinationals or groups that are spread across different countries, they're saying that, if I do this, will I also cause a POEM risk to myself? So the overlap between POEM and headquarters was significant, and it's still significant. I think if you look at the list, you can provide technical support, you can take, substantive functions, strategic visions, ongoing operations on future profit. Like, you can also call these strategic decisions or key commercial decisions. So whilst you are taking while you're giving headquarters services, can you also invariably then create a poem exposure for yourself and for the subsidiary? I mean, for your subsidiary as a group. So this is a fine balancing act, but I think given this guide, if I look at headquarter and what they try to cover just independently in a silo, I think they've done a terrific job in terms of trying to cover as many functions as possible. And I think it can be a very, very, interesting point for multinationals or groups to have their headquarters in the UAE and, ensure that proper transfer pricing is done and ensure that they can get eligible benefits.
Definitely, Prateem. Even each of the qualifying activity, the guide has gone to an extent to add a list of auxiliary activities which can be included. For example, for this headquarters services, they specifically told this training and development. If you see on a standalone basis, they may not qualify. But in aid of this also forms part
which we were seeing in certain of our other groups where you have senior management, but they sometimes have to train employees or train or develop them in order to understand company policy, company standards, maintain some kind of standardization within the group. Now, this is not getting clearly covered, right? But I think they've covered it.
Good work. Let's go ahead with an example, Prateem. This looks a pretty interesting illustration that they have given. So let's say, for example, there's a headquarter company in a designated zone. This entity is into coffee distribution. So, and they have franchises across the globe. Let's say there's franchise in a free zone, there's in a mainland, and there's an overseas franchise also. So this headquarter provides services. Headquarter services, say strategic decisions, HR support, financial management decisions. So all these services they are providing. Along with that, they also distribute the coffee they procure and give it to these franchisees. So this is a bundled activity. So I see services as well as goods. And the pricing, if you say the services as a separate fee and for the goods as a separate price. So in this case, how are we supposed to treat it? So the illustration clearly says that it has to be looked separately, the services and the goods. Services will be the headquarters services and it's a qualifying activity. And the goods will be a qualifying activity if the free zone is in a designated zone. So we have to separately look at it based on the nature and the functions of the entities and look at it. That looks very interesting.
I think it is, and I think it's grounded in how people do business in a headquarter. And not all the time you'll have goods plus services, but I was very, very happy to see this because there was a kind of an understanding that you have a headquarter but you can't do your trading function. So I think one thing that's also been clarified for holding is that that you can do holding plus a business activity as well. I think what the public consultation document had kind of hinted that you can do only holding, but I think that has also been clarified. In with headquarter, I think it's nice to see this example very honestly. And this bundled service is how usually headquarters price, or whenever you do transfer pricing, you price it as bundle. You look at the nature, and I think it's a welcome relief. And the fact that you can also have supply of goods, I think it'll open up a lot of the market. The UAE market will become a hub for franchisees, and you can operate through this model.
Agreed.
Now coming to I think this is also very critical. It goes hand in hand with headquarters. Like in my past experience, I have seen either the same entity or a different entity, maybe a subsidiary of a headquarter, perform something called a treasury and financing activity. And this typical, I think they've stuck, to the main points that were covered in the law, where you give out loans or you give out, financing to your entities. And some of the examples are very, very interesting, where even cash pooling has been covered, where if where you have excess cash, you've taken that cash, provided a loan to your subsidiary, any interest that you earn from these, from these kinds of investments would be, subject to 0% corporate tax. Now, very importantly, they have clarified that, there was kind of a, what would I say, kind of a gray area that say, if I'm a manufacturing entity and I have interest income from my excess cash and which I've invested, and what this guide has said that excess cash investments, and if you invest that excess cash, would be seen also covered under treasury and financing activity to related party, even though that excess cash has been invested not with a related party but with a bank. So that investment function would qualify under this activity. So it's a welcome relief. We were all wondering whether this interest income from excess cash deposit would be an ancillary activity or not, but it wasn't fitting into a definition, but they fitted into treasury and financing activity. So this is one of the very critical kind of reliefs or clarifications that this guide has provided. And it's good to see that they've taken a liberal interpretation. What needs to be seen again, the kind of your law or your decisions do not cover this. So your guide provides this, it expands the scope of the law. Usually we have seen how courts have interpreted the law, and something like a guide cannot expand the scope of a main law. So we need to see how this develops practically, right? We need to see whether the courts will interpret the law along with looking at the guide, because the guide has been issued by the FTA and the law has been passed by the main law has been passed by the cabinet. Some of the decisions have been passed by the cabinet. So we need to see how this can legally work. So this is a hyper technical point, but we need to see how this works and how the guide, where some points of the guide expand the scope of the main law. We need to see whether that's actually followed through by the authorities as well. Moving on to the next topic, it is the most important topic. Won't you agree, Komal?
Definitely, Prateem. Always the question, whenever the client calls, he'll be like, this is covered, this is not covered. So it's always on.
Yeah, I think, UAE is a distribution hub. Everyone wants to know whether the distribution activity is covered or not. And very interestingly, in terms of, let's look at the first example, right? I think everyone knew that this was there in the public consultation document, which was, something called a high C sales, where you are purchasing the goods from a manufacturer that is outside UAE and you're selling these goods to a retailer or distributor outside UAE, but the goods never enter UAE. Now, this appears to be covered. They've confirmed what was written in the public consultation document, and any profit margin that a distributor earns on this would be covered on a going forward basis. So I think this is also welcome relief. Now moving on to the second structure, which was initially covered by the public consultation document, where you are a designated zone company, you buy the goods from a manufacturer, you make the payment to them, you sell the goods to a retailer, distributor. Critically, when you're purchasing the goods from the manufacturer, you take delivery of these goods within the designated zone, and when you're selling it, the goods move from the DZ into the mainland, and that is how the movement of goods has been described. If you satisfy all these trade flows, then you will be eligible for this 0% 0% corporate tax on this income from this activity. There could be multiple kinds of activities in distribution, but this has been covered. Now let's move to the important ones which were not earlier covered
in the PC.
I think. So if you're a DZ company and say you're purchasing from a UAE mainland entity, now this entity could be a manufacturer or could be an importer themselves, and you purchase these goods, and then what you do, you sell it to a entity that's outside UAE, you export it out, and the goods do not even enter DZ, because they're already in the UAE. The manufacturer or the other importer in the UAE directly ships it to the retailer or distributor outside UAE. This also seems to be covered. Now, one question comes here is that, the guide could not cover all scenarios, right? They tried to cover some additional scenarios. Now, what if the DZ company buys the goods from outside UAE? So whatever the manufacturer and importer is not located in UAE, located outside UAE, and you send it back to outside UAE again, would that be covered also? There is no clarity, but given how liberally things have been, at least, interpreted, and the kind of illustrations, we need to look into it. But even though your scenario may not be covered here, we need to see whether they would be covered or not. But I think it's been quite a liberal interpretation of provisions, right? And same example as the previous one, but only difference is that when you're selling it to mainland. So they've also covered local procurement and local sale. But here, again, the goods don't enter DZ. So they have gone above and beyond the definition as well, where they're saying goods must enter a DZ and you must do some, distribution in or from or DZ. So they've really interpreted all this quite liberally, right? And they're kind of giving a lot of benefits to distributor. Definitely. I think this has been a welcome clarification, but one thing remains, I go back, your purchaser has to be a retailer distributor. A lot of people were expecting that, they would remove this condition, end user would also be covered, but they have not gone. So they have retained that if you're a distributor, you must transact with another retailer distributor. Now, another thing, they've also given an illustration that what does distribution mean? Distribution means obviously the purchase and sale. This would be SIGA, right? They've kind of defined SIGA. Purchase and sale of goods, warehousing, transportation, inventory management, order processing, packaging, repacking. So this has all been covered under what would be a SIGA for distributor. Ancillary, they've gone on to also mention that, marketing and advertising. So if you have quality control and inspection or customer support services, these could potentially be considered to be ancillary to the distribution function. They've also clarified, which is a position that everyone must be aware. So you need to earn a distribution margin. You cannot earn a commission or a sales agent margin if you are not buying the goods and selling the goods. That is, if you're not taking title to the title and the risk of the goods in any. So while delivery, you may not take delivery of the goods, but you need to take at least the title and the risk of the goods. If you aren't, and you're just acting as an agent, then that commission income that you earn will not be subject to distribution. So one thing again, how do you see, kind of how are where your customers a retailer, distributor? They've clarified that you can do a know KYC, know your customer. They can give you an undertaking and they can tell you how the goods are being used. So that's a documentation that, one can look into. So with that, Komal, why don't you touch upon some of the other activities that have been covered in this guide?
Sure, Prateem. So first, let us take about another interesting qualifying activity which was recently introduced or added to the list, that is trading of qualifying commodities. So when this was introduced in the ministerial list in 265, there was a lot of ambiguity. What is this qualified commodity? What is a raw form? How it is being only traded in a commodity market, is it? So there are a lot of questions. So this guide actually gives a clarity on this. So when you say it is not just trading in the recognized commodity exchange, it can be actually traded in the off market. So it's just tradable materials, minerals and agriculture commodities which are tradable in the recognized commodity exchange. So this was one of the clarity which was expected.
Which is very important.
Very important as well. Yes. Second is, what is a raw form? So raw form is something where the commodity is in the natural unprocessed state. So it is traded before being processed. So, but for example, let's take a product like cotton. So cotton the seeds has to be removed. It has to be bundled. Only then it can be traded. In such cases, guide has expanded and told minimal processing can also be considered.
To make it into a sellable product.
Which are tradable in the exchange. So these two are very interesting.
But I think you need to look at product by product, right?
Yes.
It's very important. I think I think they've gone on to say even steel would be raw form, while steel is obtained from iron ore, and some sort of processing is done to arrive at the metal steel. And there was a complete, gray area where the steel would be covered. They've gone on to say, because to arrive at steel, you need to do that processing, and steel is a commodity that is traded on a commodities market, that is also acceptable. So you need to see it product to product
and fact specific, definitely.
Yeah, exactly. So you need to, but it's been quite liberal with its interpretation. So it's a welcome relief to everyone, especially I would say a lot of traders in a certain free zone in Dubai. I think it's a welcome relief for them.
Yeah. So again, for ancillary activities for trading, they've clearly illustrated on warehousing and delivery. Warehousing and delivery standalone cannot, but here it appears to be an ancillary when it is an ancillary activity, we can claim it as. So moving on to manufacturing and processing, we all know manufacturing is creating a new product and processing it. So there was a doubt in this whether just doing repairs could be forming part of this manufacturing, but they have clarified that repairs will not form part of manufacturing. But the activities which would constitute a manufacturing activities, they have clearly included packaging, repackaging, production planning and all.
Yeah.
So coming to the ancillary activities for the manufacturing, they have clearly indicated post-sale activities. So that is interesting. So warranties, installation, customer queries, so all those will also qualify for the 0% relief. So
I think manufacturing, they've also said that you don't really need to create a new product. Even if you assemble, it will be manufacturing. So it's quite, you have so many assembling plants here that can also get the advantage, right? And I think they stuck to what they said even in the PCD, where I think your toll and your full-fledged manufacture both are being covered.
Covered, yes.
Toll and contracting. And
on the intangibles, so say for a software developer who develops this ERP and automation tools, those are not manufacturing. But when you sell a good, when the manufacturer sell a good which has a software embedded, say a video gaming console which has a pre-installed software, so all those are still goods and would qualify for the activity.
So we were actually kind of expecting, software to be covered, and because in a lot of countries, software or intangibles, when, at least some countries look at it, when it's in a disk, so it's a good. I think they've also covered that. If it's in the disk, it's a good. But sometimes, softwares have also been interpreted to be goods, and when it's marketable, sellable, it's kind of, I think everyone was looking forward to softwares being covered, but I think they've clarified that it will only be tangible goods, right?
Definitely.
As such.
Moving forward, another interesting one is logistics services. They have just listed down the activities which constitute a qualifying activity that includes transportation, warehousing, inventory management, order fulfillment, and packaging also here.
Yeah.
One thing which I was interested to read was a last mile delivery service. So I was always under a impression how would that be treated, but this was something which was clarifying for me, Prateem.
Yeah, I think where they've said that last mile delivery, where earlier they had kind of said that you have to carve this out.
Yes.
It has to be at 9%. Now they said that this last mile could also be included in this qualifying activity, which is very
welcome.
Yeah, I think it's a welcome kind of clarification that they've brought out, right?
Yes, Prateem. So this what would constitute a qualifying activity? What are the ancillary activities? Are not just for these activities what we spoke now, but they've also given it for the qualifying intellectual property, fund management services, wealth management services, financing and leasing of aircraft, ownership and management of ships, and all excluded activities as well. For want of time, we have just moved across. So
yeah, I think you need to watch out for specific updates on these topics. And we'll cover it separately, but and it'll come out in our posts as well, and especially qualifying intellectual property is something that we want to concentrate on separately. But watch out for this and our specific updates on the financial services like fund management or wealth and investment management, and how banking and insurance and reinsurance would be covered even for qualifying and excluded activity.
Yeah, Prateem. So moving forward, how is there were a lot of ambiguity or questions on how is a tax being calculated for a free zone entity, considering there will be both qualifying income and non-qualifying income. So the guide clearly emphasized that you have to segregate your income of your qualifying income and your taxable income separately, as well as the expenses, the allocation of expenses should be at arm's length. And again, transfer pricing plays a very, very important role. So coming forward, as you touched upon this domestic P and foreign P, so first initially you have to analyze whether this P is being created, whether that's a proper exposure, and then understand what is the profit attribution. So the guide suggests that you have to follow the OECD approach. I think all the OECD countries are appreciating it, and if you see they follow the segregated as in separate entity approach.
Yeah.
So the free zone parent as well as the domestic PE should be treated separately. The FAR analysis is the base for all transfer pricing study should be done on an independent basis, separate entity basis, and then the profit attribution should be consummated.
Just to, I think, just to reiterate, all this, whenever you get to segregating revenues through TP, segregating profits through TP, it has to be, at least substantiated with very detailed documentation and a study. There should not be there should not be any shortcuts taken here. In my experience, I would urge every business and every company to look at this very seriously wherever they have this branch and head office, kind of a segregation.
Sure, Prateem. Another important aspect is the tax losses. So we all know tax losses of a free zone entity cannot be transferred, but tax losses of component from a taxable income that can be set off against the taxable income in the subsequent period. But this cannot be set off against the tax losses of the intellectual property, the taxable income of the intellectual property. So taxable income pertaining to intellectual property can be set off only against the tax losses of the intellectual property. So this is something which is expanded. This looks interesting.
And also this loss cannot be set off against a domestic PE income, the 9%. So if you are a QFZP, your qualifying loss would only be able to be set off against any qualifying income. IP is treated separately, which Komal touched upon, but this is the understanding that most had. I think it's been clarified. Right?
Yes.
I think a very interesting point on interest has come up, right?
Yes, so they have illustrated, the mechanism has been illustrated. So for example, let me just go over with the example. Let's say there is an entity with a domestic PE as well as the free zone parent. The adjusted EBITDA on total, let's say 36 million. So 20 million pertaining to the domestic PE and 16 million pertaining to the free zone parent. And the net interest expenditure on total is around 18 million, 9 for each domestic PE and FZ parent. So how will the general interest deduction rule applicable? So if you see this, only the 9 million pertaining to the taxable income should be considered. That is the net interest expenditure attributable to the taxable income being less than 12 million a year, the interest deduction rule will not be applicable.
This is very important. I think we were all perplexed as to, in this structure, what would I do? Like I have so much interest cost, but part of my interest cost is pertaining to a 0% entity, and how would it be segregated? But it's an important relief. But here again, there could be tax planning opportunities here where I think, and I'm talking from a tax authority's perspective, from their lens, they would definitely look at such structures and see how you've segregated these, how do you bifurcate these interests also. They will look at why you've taken the borrowings, which business, if it's a term loan, where are those assets employed, free zone business, non-free zone business. If it's a working capital loan, segregation could be more difficult. What are those markers or, those apportionment keys, right? Allocation keys. So you need to look at that, and it'll be obviously questioned practically. Now, I think let's move on to what's next, right? I think, all businesses and all companies are required to now reassess how this will impact their current business model with this guidance. And I think, given the liberal way it has been interpreted, I think, it's quite a welcome relief, but definitely companies should look at their current business models and see. But obviously with the lens of GAR and general anti-abuse rules, that is always there. But I think if you're genuinely, carrying out a business from the free zone, there is substance there is enough employees there, you are satisfying transfer pricing, the margins are fine, we need to, guard will be there, but I think if you're genuinely satisfying the conditions, then why not? Why can't you get it? Now, you need to confirm, one thing is that they've asked you to reach out to the free zone authorities to confirm whether you are a free zone person or not. I would urge businesses to do that, and we need to see what responses they get. But I think practically this could cause an issue. We need to have enough documentation and the key KYCs that the guide has said for confirming whether your customer is a beneficial recipient if they're free zone customer, or they're a retailer or a distributor.
Declaration.
Yeah, exactly. Yes. Retailer, distributor. You need to get these documentation in place. Also have those intercompany agreements or those outsourcing arrangements or adequate supervision. Those agreements also, that you need to have a supervision agreements in place in order to get these benefits. comply with TP, of course. Look at all your intercompany transactions. Ensure that your model is airtight, sealed, and you have done a detailed study. And of course, ensure that your financial statements are audited, because there's no revenue thresholds. And this is a basic compliance, and I would urge everyone not to skip this. With this, Komal, I think we have concluded our presentation for today. I thank you all for joining us.
Thank you all.
And do subscribe to our YouTube channel. Listen to this session in our podcast, Spotify. We have a podcast there. And what was the tagline, Komal? Rely on Andersen and elevate your business. See you all. Thank you.